morning, good afternoon, and welcome to today's session. All lines are in listen only mode. This event is being recorded and will be made available after the call. If you have any questions during today's program, please type them into the Q&A box located on the lower right-hand side of your screen. Please use the chat feature if you're having technical issues, and a member of the production team will reach out to assist you. With that, I will turn it over to your host, Vice President of Credit Risk Transfer, Michael Reynolds. Mike, the floor is yours.
Thank you, Cass. Good afternoon, everybody. Thank you for joining us again. This is our quarterly update that we're doing. Last time we had Charlotte Gladwin, and today we have Christian Valencia. Very happy to have Christian. First of all, let's give you an update on our new CEO, Michael DeVito. Michael is our permanent CEO. He replaced Mark Greer, who filled the role on an interim basis until June 1st. Michael is a 30-year mortgage industry veteran. He's worked in virtually every aspect of the business. He spent more than 23 years at Wells Fargo, and he rose to the level of EVP, head of home lending, where he was responsible for all aspects of the mortgage and home equity business. Michael retired from Wells Fargo in 2020. His experience spans a range of economic cycles and home lending domains, including origination, servicing, portfolio management, secondary marketing, and credit risk. And for the past 2 decades, he's been one of Freddie Mac's customers. So he's commented quite a bit what it's like to be on the other side now. And then I think perhaps very importantly for this audience, he is firmly supportive of our CRT program. What are some of the highlights from 2021? Just last week, Global Capital named Freddie Mac our RMBS Issuer of the Year as part of its 2021 Securitization Awards. We are really proud of this distinction. It's for the work that we did in 2020, post-COVID, early days in the program, our transaction where we came back. So with the team working remotely, we kept our CRT program moving forward, as did many of you, and that was on top of our moving our program to SOFR, which we executed last year. So we were absolutely really happy to be approved or receive that award. We also did our second CRT cast. This was with Jim Benison. If any of you have an interest, please listen to it, or if you don't know how to find it, reach out in the chat and we'll make sure you find it. I think it was really great. We've worked with Jim for a long time, and gives the perspective of Arch MI and how they use CRT, and as well as just digging into some aspects of the mortgage business. So our CRT cast seems to be fairly popular, so we're going to continue to do that, and we'll be announcing our Q3 guest a little bit later this quarter. We also released our Q1 CRT research package, which has the insights and forecasts. You can view that on our website. We'll be updating that shortly. We have a preview of some of that package in here, where we got impacts of the stimulus, vaccinations, economic recovery, housing trends, as well as some forbearance trends. Let me start digging into pieces of that. So we have a recovering economy. According to the latest GDP forecast for the last month, the U.S. is like 90+% of where it was compared to early March 2020. So a very rapid recovery, V-shape type of recovery, with aided by very significant government stimulus. The latest 2Q GDP forecast, we can see on the right-hand side, the average is 9.8. Tremendous growth, clearly very different than the 2007 recession. Relatedly is home price appreciation. It's home price appreciation is the highest on record this year and continues to be strong with a 15% year-over-year growth. That was as of April. That's continuing to build equity value across the country. 7.9 trillion is the estimated total equity value. Clearly, a 50, growth rates of this high are not sustainable, and we are starting to see some slowdowns. But for sure, for existing homeowners, it's creating quite a wealth opportunity. And for credit investors, it's really translating into a significant deleveraging scenario. Big driver of the home price appreciation is on the supply side. So there continues to be a housing inventory shortage. We've talked quite a bit about this. In particular, the housing shortage is concentrated in entry-level affordable homes. Nationwide, 54% of homes sold above list price, and it is impacting affordability. However, let me try to point this out. If you look at the blue line in our chart, that's the payment to income ratio, which is the left axis. And we see that there has been a rise at the far most right point as of June, 20.5%. Compared to historical averages, that's actually still within actually a little below the average. Very much driven by low interest rates, so that that will be a factor. And as we can see, the 30-year fixed rate continues to decline, and rates have actually are still hovering near their lows even as of today. Another interesting aspect post-COVID are some migration trends. So on the first part of migrations in terms of like the workforce, a lot of folks are looking at it coming out of the COVID experience, and they are retiring. So that has accelerated those trends of retiring. What those folks will do is to be determined in terms of where they'll be moving. But if you look on the left-hand side, the green line is that retirement trend, and then the right-hand side with that red line, we've got nearly jumping up to 51 million of the U.S. retiree population. So that's a substantial shift, macroeconomic shift. On the right-hand side, what we're looking at is how the pandemic has accelerated migration trends in coastal markets, where between looking at move-outs and move-ins. So you can see big coastal markets, San Francisco, New York, have had very, very substantial move-outs, exits from those urban metro areas. The outflow is likely to subside, as a sizable share of remote workers do plan to come back into the office. The middle set of metro areas, let's call it Chicago down through Baltimore, they still have a net negative move out. So you can see on the scale on the bottom, it's still a net negative migration, but the pace of move outs has slowed significantly in those low cost post-industrial cities. And then you have a few metro areas down the bottom, Dallas, Charlotte, Austin, where move-ins are actually accelerating into those Sun Belt metros. Household balance sheets are on solid footing, with less reliance on consumer debt, higher savings rate, low financial obligations, and as we mentioned earlier, record home equity. So as we look at consumer debt, that leftmost panel, uh, we're from 21, where we've come down a little bit. The personal savings rate is very, very high. That represents a lot of dry powder in aggregate. And the, in contrast, like the financial crisis had high financial obligations, declining home equity, and low savings rates. So clearly the consumer balance sheet at this point, um, for this particular COVID stress, is very, very different situation um, than where we were back in the financial crisis. Credit quality, U.S. is strong. Um, the arrows here on these charts are pointing out the current credit quality. Those are the right arrows compared to the last crisis, financial crisis, which is the left arrows. So DTI at funding was much higher than where we are today. FICO scores back in 2008 are much lower where they are today. That's even with a little bit of recent dip in credit scores. And of course, LTVs are much lower today. So credit quality, again, very, very strong. Really not much of a new update compared to last quarter. Delinquency trends. The historical data on the left-hand side of the chart shows post-financial crisis delinquencies were trending downward prior to COVID. So with COVID, we had our massive spike. As I've discussed previously, the Freddie Mac book continues to have the lowest delinquency rates, much lower than FHA, VA. And on the right-hand side, look, you can see our CRT portfolio. Delinquencies are continuing to trend down, and forbearances are continuing to trend down. There's almost no change in the serious delinquency rate for non-forbearance loans. Excuse me. Digging this a little bit further, the forbearance rates continue to trend down as loans, and I'll show you in a couple of slides where loans are exiting to. Overall, the state of the book continues to improve as borrowers are recovering and certainly aided by the government stimulus. Now, when we look at the GSE's portfolios and we compare that to PLS, FHA, VA, what we're seeing is the GSE portfolios are recovering, exiting forbearance at a faster rate. So you look at these tables on the right, and the GSE rows are on the bottom. We had 970,000 loans in forbearance plans as of December. In June, that has a 34% decline down to 641,000. So that rate of loans exiting forbearance is very high, much higher compared to the 27% of FHA and VA loans and the 15% decline in the estimated decline for portfolio and PLS. So what's happening? Where are the loans going? How are loans exiting from forbearance? And this is a chart that we've shown you previously. So on the left-hand side, so first of all, 74% of loans, this is specific to CRT transactions. 74% of the loans have exited COVID forbearance. 8% of those have always been current. 92% of them had some form of delinquency. Of those loans that had missed at least some payments, 40% of them have exited by using the payment deferral. 33% of them have paid off on their own, have paid off, and 18% are active, but they self-cured. So those are the dominant three factors: payment deferrals, just outright refis, and, or payoffs, I should say, and then 18% have self-cured. And this is a table that we always update on our Clarity platform. So, you know, how is that translating? So again, I think really no surprise for this audience. CRT performance is continuing to perform really well. The delinquency rates are trending down. There are foreclosure moratoriums in place, so we're not going to see the same types of losses. To the extent that there are modifications, they'll follow the loss waterfalls, and some of those losses will be applied to outstanding CRT transactions. But the overall loss rates at this point continue to be very, very low, with no transactions having more than 2 basis points of loss associated with them. So these are the actual loss transactions. So overall performance is really well. Of course, we'll have to continue to be monitoring the delinquency pipeline as forbearance periods end, and foreclosure and eviction moratoriums are lifted. We'll see how those impact performance. Generally speaking, with such robust HPA, there will be less opportunity. There'll be more opportunities for the homeowner to exit if they're not able to come up with some type of loss mitigation strategies able to keep them into the home. We continue to track ACE. We receive a lot of questions around ACE and how ACE loans are performing with CRT pools. So here we're looking at, ACE versus non-ACE. It should provide comfort related to the ACE program. So when we look at outstanding balance of active loans, is on the left-hand chart, and then the right-hand side is cumulative performance. In terms of active loans, we do see ACE has a slightly higher D90 rate than the non-ACE loans. So the non-ACE population, D90 plus, right around 4%. ACE loans are just a little bit higher. That's for active loans. One of the things that we have seen from a credit perspective, a positive from a credit perspective, is the ACE loans are prepaying. So when you look back and look at the cumulative ACE performance, which we have on the right-hand side, we see that the ACE loans continue to have delinquency rates that are lower than the non-ACE loans, starting to be a substantial difference. So we'll continue to track this, and we make ACE available as an individual characteristic that can be tracked in the Clarity tool. But performance so far continues to be really robust. So with that, again, we want to just reemphasize how much effort we're putting into our data transparency. We have updated our historical data sets to expand access to the loans that are included in that data set. We have over 45 million loans in that data set. We've updated Clarity. Clarity 2.0 is here. Charlotte gave a preview of that in our last quarter. It's since been released. It allows you to compare CRT transactions much more easily. We've enhanced the way to do the proxy cohorts. We've put a lot of additional information into the help and user guides, and we'll continue to put enhancements in there. So please use that Clarity tool and continue to submit requests and updates for how we can improve. So that's the run through of the economic updates. We will have a few minutes. I know I went through that quickly. We will have a few minutes at the end of the call to take any Q&As on any of that or other material. But I did now want to turn it over to Christian and have Christian spend a few minutes talking about stacker and secondary market performance.
Great, thank you, Mike, and thanks everyone for joining us for this event. I'm going to go over the market, how things have been, and first I'm going to start with just looking back at what the market looks like from start to date, and what we issued since 2013. So you can see here issuance by year, and then some of the pay downs, and when you go to 2020 and 2021, you can see that pay downs have outpaced issuance in that market. In 2020, the combined issuance of both Stacker and CAS was just over 12 billion, with Stacker going over 10 billion of that. Then in 2021, it's all under Stacker shelf, so over 50 billion outstanding this market, which has grown significantly and continues to be very robust and very liquid market from the RMBS perspective. So very proud to have been able to develop this market over the last 7-8 years. So I'm gonna move to the next slide, which just covers our Q2 issuance, and we have been a very programmatic issuer. We've been issuing both under the Stacker and the ACES shelves and issued different type of transactions. As you can see here, we issued 4 transactions during this quarter, and year to date over 9 or close to 9 billion. When you include the deal that priced yesterday, we're actually at over 10 billion of issuance. The transaction from yesterday, which I probably think it's going to be very relevant for everyone, was over 1 billion one, and was the largest B1 and B2 classes that we've issued in the program history. So over 330 million of bonds each. Very strong demand on that transaction. We actually had 66 unique investors that participated in that deal. And on the B1 class, we had 39 unique investors. So it was the most in the total B1 ever in the program, and on a deal the most since 2017. You got to think that back in 2017 there was potentially more investors that would be added to the deals as this was a new program, but this was a very strong demanded deal. Some of these classes had like high single digit subscription levels. The B2 was more smaller, with around 1.5 or just under 1.5x, but the other class is very well subscribed, and from what we're seeing in the secondary, which just started free to trade today, seems like the break is breaking well so far. Also, as you can see here, we have had good subscription levels across the different transactions, not just on the Stacker side, but the same thing on the ACES side. An important thing that I would like to note is also, on the lifetime, we've had over 240 unique lifetime investors on the Stacker side, and even more than that when you combine both Stacker and the ACES program. I'm going to go to the next slide and really talking about that unique participation, and as you can see here, money managers on the M classes are really the largest participant with over 50% of the M classes. The ACES program, that represents a big percentage of our investor base, with about a third of that, and then on the reinsurance side, and a similar number under the B classes. Hedge funds, they've been more participant down on the B classes, but they also participate on the M classes, particularly the M2. I wouldn't very little on the M1 event. And then you have a number of other type of participants like REIT, sovereign funds, insurance funds, and some small participation of bank credit unions on the space. So we've seen a very strong participation this year with over 111 unique accounts participating when you combined both the Stacker and the ACES program. On the Stacker side, it's a little over 90. So we are getting very close to the number we had in 2020, which was over 100 unique investors. Even after COVID, we've continued to try to develop new relationships with investors, as we understand that dealers are somewhat limited to the amount of capital they can put there to use, and having a large diversified investor base is critical for the liquidity of these programs. So we continue to do that even under a scenario where we've been more remote, but we continue to reach out to new investors, continue to try to develop those relationships, and that has paid off, I think, in these times. Moving on to the next slide, I just wanted to just cover a little bit of the secondary trading, kind of where we've seen spread so far, and as you can see here, we're comparing somewhat the high LTV, the low LTV series, as well as the high yield index, and spreads on the M2s, beginning of the year, depending on whether you're looking at the low LTV or high LTV, they were in the mid 200s or low 200s, and have come in significantly now. The low LTV deals are in the around mid high 200s, and the high LTV deals around the 200 ballpark. So things have come in quite a bit, probably somewhere in the 25 to 50 basis points on the M2s. The B1s, those have stayed relatively, there's been some volatility there, but things are kind of where they started the year, around 300 on that low LTV, and we priced yesterday that B1 at 305, so I considered that that's just slightly above, and on the high LTV that actually has come in from high 300s to the low 300s on the B1s. And the B2s also, we've seen some of that spread coming in. Yesterday, again, we priced that DNA transaction around 550, which is around where things started the year. Important to note that it was the largest B2 class that we've priced in the program history. So that usually, the largest the deal, probably the more you have to pay on the spread basis. You're based on the last dollar of interest in that transaction. But very strong demand again on that class, over 20 investors. So there was 23 investors yesterday. That information is available again on Clarity. A lot of these information that I've been showing in the previous slides. Also, you can look in Clarity, our data tool that continues to provide enhanced information and real lifetime information for investors when they're looking for that. And this last slide will cover maybe trading volumes. As you can see here, we're starting with June of last year. After COVID, started to see some of those trading volumes in June. They came down significantly from the March and April, but March, April, May, which had significantly higher trading volumes given a lot of volatility, but started to pick up, and we're for the year around 2 billion on average, including those, or a little over 2 billion, 2.4 on average for that year. Then we're seeing this year things have picked up on the trading volume side, and this is something that we've seen Stacker to have a larger market share. As you can see here, June of last year was around 40%. Now we've been more in the 50 and all the way up to 60% share. So we are seeing that, given that we've been the primary issuer, or the only issuer in the market since last June, the market share has increased on the Stacker trading side. It's important for us to continue to see that share continue to increase. So we do expect to see that even be higher as we continue to issue more the rest of the year. We do expect to be a consistent issuer for the rest of 2021. But there's potential for changes there on the structures. This last transaction had one change that I think people were aware. The B3H didn't have a a coupon that was above SOFR, so it was only a SOFR flat, which reduces the modification kind of retention risk on our end, and it passes on to the investor that risk. So with that, I'm going to pass it back to Mike and for some closing statements, and then we can move on to the Q&A session of this webcast.
Thank you, Christian. And we'll put up a poll. It's here. It'll be up, for the next 15 minutes. But please, if you have thoughts on what you want to hear for the next podcast, please put that into the poll. We do have an opportunity to answer questions, Cass, if there are any questions coming in. Why don't we see if Christian and I can answer those?
Awesome. And we do have a few. We do have a few questions. I am just going to direct the audience that if you have any questions, please enter them into the Q&A box, and we will read them out for our presenters. So the first question is for Mike. Mike, can you talk about the issuance calendar for the remainder of the year?
We just did our Q3 transaction for the low LTV, as Christian just talked about. Will we do another transaction before the end of Q3? I think we will. I think we will. So you can continue to expect us to offer the high LTV and the low LTV transactions pretty regularly for the balance of the year. As Christian said, we are still trying to assess what adjustments, if any, should be made related to the updated capital rules. And that may impact the amount and frequency of CRT transactions that we issue. But as we've seen throughout this year, we've been very active, and I would continue to expect us to be active. But there's potential, for some smaller sizes. But again, it's all kind of relative because the collateral that we're credit enhancing is based off of acquisitions roughly 6 months ago. So bottom line, we'll continue to have transactions. We expect to have transactions again here in Q3 and then again in Q4 for both the high and low LTVs.
Great. We have another question for Mike. Are there any other changes we can expect for the remainder of the year?
There's nothing. Great question. There's nothing we can announce at this time. I mean, certainly we have looked at the capital rule and the ERCF capital rule, and that does encourage. Let me back up. As I've said many times, CRT is a loss mitigation tool, and that is irrelevant, that is not based on capital rule. That is just keeping the company in a certain loss position, and that's always happens. Where our board of directors and senior management sets risk appetite limits, and we then execute CRT to make sure that we're achieving those limits. But then secondarily, it is a capital management tool. And although we're in conservatorship, we've always been running the business as if we were a private company, and managing capital is a very important aspect. The ERCF, final enterprise capital rule, has some impacts in there that would require some changes. And also, well, it doesn't require changes, but the CRT could probably be adjusted a little bit to be more efficient inside that framework. You also have to keep in mind from the enterprise's perspective, we with recent PSPA amendments, we're now able to retain capital. So CRT is no longer just a sole source of protection. We are actually slowly building up our capital base. So those are potential sources of changes that could be modifying the CRT. I wouldn't expect I would describe them largely as tweaks versus wholesale changes. But the other big event is COVID. So what we saw with COVID is we saw some very, very high delinquencies, and although we're not out of it yet, it's my expectation we're not going to see the same relationship we have historically between delinquencies and losses. Meaning, in this particular example, we're having high delinquencies that probably are not going to translate into the same types of high losses that you would in, when you look at that kind of delinquency rate back in the crisis, for example. That's kind of an obvious statement, but then when you think about that and you apply it to how the CRT outstanding CRT float is, we like, okay, probably some things that could be adjusted to relate to COVID. So we don't have any announcements right now, but those are some of the big pieces that we're looking at. And of course, again, CRT is a relatively young asset class. This form is less than 10 years old. So we're constantly looking to make improvements. And that's both from an issuer perspective as well as incorporating feedback, from the markets, both capital markets and reinsurance markets. So when we have something to announce, we definitely will, but we have nothing more, no more details to share at this time.
Great. And Mike, you're super popular today. One more for you. Are there any changes in the messaging from FHFA as a result of the change in leadership?
Changes in messaging. That's kind of a broad question. I think, Acting Director Thompson, has spoken publicly on a number of issues. So I would just go look at that or raise that with FHFA. I think, like I said, yeah, I think FHFA already has made a number of public statements. So I would just refer you to those.
Great. Another one for you, Mike. What do we think about the impact of forbearance extension to 18 months and the foreclosure moratorium ending as of July 31st?
Those are very interactive with each other. If you're continuing to extend the forbearance, even if the moratorium is lifted, those loans are still gonna be in forbearance, right? So it's kind of in a way like the moratorium is still there in that regard, at least for the loans that are in forbearance. Now, there are definitely loans in the pipeline, the foreclosure pipeline, that would be affected by a lifting of a moratorium, an eviction moratorium. Those might be loans that are already, heading down that path and never had an opportunity really to go through they were heading down that path prior to COVID. That's what I'm trying to say. So yes, the extensions are nearing their ending dates. The forbearance windows are nearing their ending dates. As we've shown earlier, we've had quite a number of loans have been exiting forbearance, even prior to those 18-month endings. At some point, yeah, the foreclosure process is going to pick back up. And I'm sure some loans will go through that process and end up having to go through foreclosures, and we'll sell the properties. That'll definitely happen. But we've been the announcements around the flex mods and what we're doing on the last minute waterfall. There's definitely an interim step in between, right? We have the deferred payment mod available. Deferred payments are available. If that's not enough, we have other options to try to assist the homeowner. But yes, eventually the actual foreclosures will pick back up, and you'll start to see that in our hitting our REO inventory. Yeah.
Thank you, Mike. This next question is actually for Christian, and it's about interest rates. Do you view potential rises in interest rates having a significant effect on the payment to income ratio?
I think that, you know, the interest, if you're talking about the interest rates on the mortgage side, if mortgages increase, that would result in a higher payment to borrowers. Potentially that could result in debt to income ratios to rise. That would assume that also, you know, home prices continue a similar approach, and potentially that could result in a little bit of a cool down on these prices that have, as Mike showed in one of the slides, has increased, you know, by, I think the last number there was showing around 15%. So potentially there would be somewhat of a cool down on those prices going up, and but it would have an impact on potential mortgage payment of borrowers. If rates increase, also that would have an impact on prepayment rates on the current most recent transactions that we've issued, which have you know, sub 3% mortgage rates.
Thank you. And I'm just going to ask the audience if you have any questions to put them in the Q&A box. We are busy going through those boxes and making sure that we update you. So I'll give you just a moment to collect your thoughts. And I see a couple of people are putting some stuff in. And while you're doing that, I just want to remind you that that poll is still up. Please feel free to share your thoughts on future topics and sessions. We want to make sure that we're bringing you content that is important to you. All right, so it looks like those folks are still collecting their thoughts, and a couple of questions have already been answered. So I'm going to direct the audience. If you have any additional questions, I'm going to drop into the chat a email address for you guys to send your question to, that somebody will get back to you as soon as possible with an answer. And then I'm going to hand it over to you, Mike, for closing.
Cass, that's great. Thank you very much. And appreciate you and the team trying to read through the chat to pull up the questions. And as Cass said, if you're trying to ask a question, we didn't get to it, send it in and we'll definitely get back to you. Thank you for your time. We think it's really important to up our outreach, and hopefully you're finding these sessions are worth your time. Materials will be posted. So you'll be able to get access to the charts for your own reference. A number of them are based in Clarity, so that's always available to you. And we really do appreciate your support in buying the transactions, supporting the transactions. And we look forward to catching up with you individually when we're able to do so. Thank you. Have a good day.